So I honestly think that Constellation Software is at a pretty attractive level for investors that have been priced out of the name, have always wanted a position, but it just kept going up against them. So I think this is kind of what I would call like a relatively easy buy. Like this might be, the equivalent of like a Tom Lee granny shot right now. So I think software has been indiscriminately sold off. And then if you look at the leader in software in Canada, it's Constellation. And the drawdowns pretty much just in line with major historical drawdowns for the name, and yet it still has a 35%.
1, 2, 3, 4.
All opinions expressed by Chris, Michael, and Ryan are solely their own opinions and do not reflect the opinions of 5i Research or i2i Capital Management. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Employees of 5i Research may hold positions in the securities discussed in this podcast.
Welcome to the 15th episode of The Exponent with 5i Research. My name is Chris. I'm the head of research with 5i, and I want to welcome you, our listeners, to our journey into the heart of the Canadian markets. Our mission is to empower investors with precise insights and in-depth research into stocks, the economy, and more. With that said, let's dive into the Canadian and U.S. financial landscape. So today I'm joined by my co-host, Ryan. Ryan, welcome.
Always fun to be here.
Yeah. So it's been an exciting week for sure. So we've had, the Federal Reserve interest rate decision. We had the Bank of Canada interest rate decision, as well as inflation from Canada. And then also we're seeing some solid market momentum following that Federal Reserve meeting. So pretty good week so far. So yeah, how are you feeling about things out there?
Yeah, it's been a jam-packed week with central bank decisions going on, right? So we had Bank of Canada dropped the interest rate by 25 basis points, citing you can probably pull it off the top of your head better than I can, but I think they're citing just some economic uncertainty from the tariff issues and things like that as kind of a bit of a support as to why they were cutting rates there. And it was largely like no surprises. Markets were largely expecting that cut as well. So I'm sure a lot of people with mortgages and credit lines will be applauding that change. And then the Fed followed suit, I guess you could say. They saw the rate cut in Canada and decided they needed to do it too. But no, they also cut rates by 25 basis points as well. Again, very well telegraphed rate cut, so that wasn't really a surprise for the markets. But what was maybe a bit more surprising was, I guess people call it dovish. So they came in like when with the press release after the rate cut, sort of indicating that they're probably leaning towards more cuts in months to come as well, or months to come actually probably. So I think markets are pricing in at least one more rate cut, like 25 basis point rate cut before year end, and potentially two. And that was call it a pleasant surprise for the markets as well, and a bit of maybe a less expected. So I think there's maybe, again, everybody knew the Fed was going to cut. I think maybe what people were less sure about was whether it was going to be a one and done type of cut, or what sort of their wording around sort of their outlook for whether rates, how much further the rates are going to come down. So good news, I guess. And it was just interesting to listen to kind of the Q&A session, because the Fed chair kept on mentioning how they're in a tough spot, right? Of you have inflation, it's under control, but higher than they'd like, but they don't want it to run either. And then you also have the weakening labor market, and you don't that to kind of crash or to fix that as well. So you can kind of just sense the tough spot that they feel like they're in. So
balancing the risks. That's the operative word, right?
But to help that out, I guess earlier this week, I think it was this week. The CPI came out as well, and it was cooler than everyone expected, which was nice to see. And again, I think it's just kind of made that decision for that cut just a bit easier for them, because they just had a bit of a support to cut rates without being too worried about things heating up too quickly.
Yeah, for sure. Like headline is moving definitely in the right direction, and then core is kind of like a little bit sticky, but I think from most of the research that I've seen, it's a lot of it's shelter, which is kind of just lagging, and or, I mean, a lot of it is like calling individuals and seeing what they think they could rent their house for, and so a lot of it's like kind of inefficient inflationary reporting.
And well, if you're calling people, nobody answers their phone anymore, right? It's all
Who's
spam
answering?
calls. So
Yeah.
it's probably hard to get people to answer any questions.
Yeah. Nice. Okay, cool. So then did you want to talk about some of these interesting market and company news?
So there's been some kind of a lot of stock specific, company specific excitement going on lately. So on the Canadian side, MDA Space, which essentially builds satellites, is one of the main pure play space companies in Canada. They got hit really hard. I think I'm losing track of time. I think it was last week, maybe 2 weeks ago. But they got hit. I think there was a 20 or 30% drawdown on this news. But essentially, one of their big contracts, EchoStar, got purchased by SpaceX, and so they had to cancel a contract that EchoStar had with MDA. So the contract is worth about $1.3 billion, and on the high end, it could have been like a $2.5 billion contract for them over multiple years. And after that news, their market cap dropped from 5.5 billion to 4 billion. So, essentially the market has now priced out the full value of that contract very quickly. But I think I don't know if it's getting missed, but something to think about on this one is that so the drop happened because it wasn't really related to the company itself. It wasn't related to execution, to what they were going to do. It was just related to this kind of one-off event where a deal happened. It was under their control, and it wasn't really because MDA was doing wrong. They were unhappy with them or anything like that. It was just a kind of unfortunate series of events, but nothing that really hurts the long-term outlook of that company. So I think it's kind of an interesting way where it's now cheaper. I think it's trading about 20 times forward earnings at this point, and that growth trajectory is not really changing a whole lot outside of that one contract that was kind of out of their control.
Yeah, no, it's a really fair point too. Is like, especially if the contract, I don't know how many years it is, but if it's like a 1-year contract, that means that they have essentially, the market was pricing it at like a 1-to-1 sales if the market cap dropped by the equivalent of the contract. And so like you were saying, like that doesn't, by just taking out the value of that contract from their market cap, it's not really factoring in the potential for market management to continue to execute with that company.
And you're assuming there was no discounting happening in that deal either too, right? So
it's interesting.
Pretty big drop. I think it's one to look at. And again, I like that it's one of the only pure play space names in Canada as well.
Yeah. That's an interesting theme going on right now in space. Yeah.
Another one is Canada Goose, which I'm sure many people are familiar with. So there was a few weeks back, CNBC reported that they're entertaining take-private offers, which value the company essentially 1.8 billion Canadian. And so obviously the stock has moved. I think they've come down a bit from what that rumored deal price is, but just interesting kind of developments on a Canadian company as well. But another example again is where call it good companies, good brands, large companies in Canada continue to get taken private or taken over by U.S. companies. So I mean, probably honestly a good outcome for Canada Goose here, but maybe a bit of a bittersweet outcome as well. Turning to the U.S., there was Oracle, which I think left a lot of people's jaws on the floor after their recent earnings.
No kidding. Yeah.
They had an earn, and I can't remember what I think it was up at least 25%. On the day.
Yeah, almost. Yeah, it was like 30+% at one point too. It was just wild for a large company like that.
And so the main thing at the quarter itself wasn't like the actual results, let's call it, wasn't anything to write home about, but the big thing was their remaining performance obligations, which is kind of like, it's not backlog, but it's sort of like backlog. We'll say that. But their RPO skyrocketed, and it went from 138 billion to 455 billion, which I mean is just such a hard number to even digest on its own, right? And so what happened is most of it seems to be OpenAI related. So obviously OpenAI is spending boatloads of cash, and them and Microsoft are kind of starting to kind of like diversify away from each other, it looks like. So it appears that a lot of that jump in RPO is from OpenAI moving some of their business over to Oracle. And with that trend, you're seeing a lot of this kind of happening. These like big contracts diversifying out from what was maybe a small handful of companies to more and more companies, and that happened with Nebius as well. And Nebius is a company we hold in our portfolio at I2I, but they've been a big beneficiary of this diversification between OpenAI and Microsoft, because Microsoft signed a $17 billion 5-year contract with Nebius. I think it was like 2 weeks ago now. And when they signed this deal, Nebius had pretty much a $17 billion market cap. So they signed a deal that was the size of the company itself. So obviously very, very significant, and it sent the shares up about 40% on that day. And so, obviously transformational deal. And I don't necessarily know if there's a reason to think that the company's done growing yet either. There could be other, maybe not as big as this one, but there could be other deals out there certainly, and they seem to hint at that in their press release as well. So this is a company they were targeting heading into year end here. They were targeting $1 billion in annual recurring revenue before this deal. And so obviously the timing of how the revenues come in for Nebius is going to be, there's some uncertainty there. It's going to be a bit lumpy, but essentially if you kind of smooth it out, this deal takes them from 1 billion ARR to $4 billion in ARR quite quickly, which is obviously a very, very significant jump. And then final one that's kind of catching some of this AI, these AI windfalls, is Intel, which just happened today. NVIDIA invested $5 billion in Intel at a price of $23.28. And I think now it closed at like $30 or so at the end. So not a bad quick trade for NVIDIA buying into Intel there. So I think it's and they're doing this to essentially help or to partner with Intel to build AI chips, high compute chips, things like that. But I think it's interesting because NVIDIA they're almost like single-handedly building out and seeding the development of an entire industry. Maybe you could say NVIDIA and OpenAI together or whatever.
Yeah,
right. But like they're essentially being like a kingmaker right now in the market, which I don't know if it's a good or bad thing over time, but it is the truth, I think.
Yeah, right.
And they're just like they're really just like forcing through the build out of this whole like infrastructure of this space, which is just a very interesting to watch what they're doing and how it's all developing.
Yeah, it's amazing to see like how quickly that company has ramped up and really become like the only name in town. I mean, there's just not many chip makers out there that you could say like could easily surpass or even compete with NVIDIA at this point. So it's pretty interesting. But of course, names can fall out of favor. But I don't think that's going to happen anytime soon.
Yeah, so lots going on, lots of news in the last couple of weeks, which is always keeps things interesting. That's for sure.
Yeah. A good list of development there. And do you have one last thing there?
Yeah, it's the money show. I mean, we can talk about that, but so we were just at the Toronto Money Show last weekend. Yeah, and it was
been a long week.
I'll get your thoughts, but it was fun. It was good. It was really nice to see 5i and Canadian Money Saver people. And talk about markets and all that kind of thing. I know you did you want to give a quick and dirty on the presentation you did for the Money Show too, maybe? Or?
Yeah, sure. Yeah. I presented and my presentation was really on the, characteristics of a compounder. So using like evidence-based research, but also just some qualitative factors of, the common traits that we see in compounder stocks. So specifically, I was looking at names that have a history of compounding their share price, including dividends, by 15% or more over the last decade. And essentially, the spoiler is essentially that, the names that investors are least likely to want to own, they're the names that, are volatile, they're expensive on a valuation basis, and they pay little to no dividend yield. But the spoiler is that those are often the names that are true compounders, or they've compounded over the last 10 years nicely. But the names that have, low compounding rates, they're the ones that are cheap on a valuation basis. They pay a nice dividend yield, like typically, above 4%, and they're not volatile. So we find that, investors often seek out the latter names there, the ones that aren't volatile, that are comfortable to own. But really, the reality is that good investing is never comfortable. Doing the right thing is often going to be uncomfortable. So, that's kind of a mantra with like buy the fear, sell the greed, etc. But then when you chunk it out into individual stocks, it's the same kind of principle. Own things that feel uncomfortable, but likely there's a reason that those names are trading at high valuations or are volatile. It's because the market's essentially awarding them that premium valuation.
Yeah, if you're too comfortable, right, then you should be. That's when you should be scared. When things feel too easy, too good, whatever.
That's right. Yeah. So I had a really good time at Money Show too. It was great to see everyone. Great to have conversations. I mean, we've done a lot of, really, some good stock picks in the model portfolios over the years, and some nice names. And it was just great to hear some stories of how people have, bought those stocks. They've done well on them. So it's really good to, get that boots on the ground kind of vibe from everyone. So sure. A good time. Cool.
Tweets of the week.
Yeah, let's do tweets of the week. So I'm going to throw up a tweet here. So this is from Beth Kindig. So kind of going on that AI kind of theme again. So she talks about this. She mentions that AI robotics startup Figure raised $1 billion in its latest funding round, valuing the firm at $39 billion, with participation from NVIDIA, Salesforce, Intel Capital, and Qualcomm Ventures. And so, this is really reflecting like a 15-fold increase from Figure AI's $2.6 billion valuation in 2024. And it's driven by investments from these tech giants. To me, this is, signaling a surge in confidence in humanoid robotics, especially amid like a projected multi-trillion-dollar market. And so Figure has like a Helix AI system. It's bot queue manufacturing. And it also leverages GPU infrastructure from NVIDIA. And so like the long-term thesis for robotics is that, AI-driven robotics could really address labor challenges, with 80% of US manufacturers expecting workforce gaps by 2030. So I thought this was interesting. It's not a public company, but we're essentially seeing, public companies, those tech giants, investing in these private robotics firms. And I think this is a space that's really going to heat up in the coming years. As we've seen, like the AI chip manufacturers kind of ripple into data and infrastructure, but now we're going to see, I think, the rollout of robotics and kind of like moving into that era of physical, like the physical layer being met with AI. So
Yeah, I can't imagine the amount of compute that'll be needed when we have robot pets in our house or whatever, with eyes looking at every little thing we do and all that kind of stuff. Dude, does Figure make robots or?
Yeah, they have the US manufacturing and everything, and apparently they're pretty good. On par, or at least even potentially better than the Optimus from Tesla. So it's pretty interesting. And then the next tweet, so I don't know how visible that is, but this is essentially a tweet from Koifin, and it's showing Uber's free cash flow and the evolution of Uber's free cash flow. So, you can see that free cash flow was heavily negative in 2020. It begun to expand going into 2022. And then you see this like inflection point in 2022. It flips positive, and it just pretty much goes vertical for the quarters thereafter, all the way into 2025. So, I wanted to showcase this because I think it's like a really interesting development for free cash flow. And we see that sort of look like that kind of chart for free cash flow and other profit metrics across different companies where, they have operational leverage And as soon as they hit that like inflection point, sales growth can be steady, but free cash flow just starts to rip higher essentially. And so, there's studies out there that suggest strong free cash flow growth correlates with stock price momentum. And yeah, essentially companies that have high fixed cost base with low variable costs, once the revenues surpass that fixed costs, those types of companies really start to see profit grow rapidly. And when you couple that with high sales growth, and then you have profit margin expansion, that leads to really, exponential growth in profits. So kind of a nice little chart there from Koifin.
Yeah, growing revenues, growing margins. It's good. Good combo.
Yeah, nice combo. Can't go wrong with that. Yeah. Okay. So then I think you have some noteworthy dividend cuts and raises in Canada.
Yeah, I think we can skip over this one. There's not too many.
Right.
I mean, I'll say them just because I have them here anyways, but nothing too exciting. But
Yeah.
Labrador Iron Ore, ticker LIF, raised their dividend by 33%, and Savaria, ticker SIS, raised their dividend by 3.7%. So
nice. Okay. Yeah. Not too much in the dividend space, I guess, right now.
Yeah. Well, we just did one somewhat recently too.
Yeah.
Did a podcast somewhat recently. So we'll go straight into the Q&A, I guess.
Yeah. Sounds good. Yeah. Sure. Start it off. Yeah.
So first one, some of the higher risk, more speculative names out there have very high short interest. How much would this impact your investment making decision? And are there any extra considerations you take into account? So, I mean, typically we would probably start and not make it a habit of owning high short interest stocks. They can work out well. There can be powerful gains behind them if you're right. Kind of playing that contrarian side of things. But you need to have a divergent view and like really be certain as to why you're right versus the market on a high short interest stock, because that short interest is there for a reason, right? So the first thing, I think, if you're looking at a company with high short interest, you just have to understand why it's there. And if you don't want to own the name if you don't know why that short interest exists, because there's probably some sort of real thesis or real risk as to why people are trying to short the stock, right? Now, if you understand why it's there and you don't agree with it and you think that thesis is wrong, then fine, there could be a case to make to invest in that company. So that's kind of, I think, step one there. Step two is just expect volatility. These high short interest names tend to be kind of like story stocks or battleground stocks, where every headline is looked over with a fine-tooth comb and they move, swing around wildly, essentially. So, it's just expect volatility as your default approach as well. So, I was kind of saying that you don't want to make it a habit. Like there can be a lot of potential in these names, but you certainly don't want a portfolio of just high short interest stocks, right? Because one or two might work out, but oftentimes when people are shorting a name, it's because there's reasons to be short it, right? Whether it's fundamental or some sort of contract cliff or whatever it is, high bet, that kind of thing. So that the odds of success are probably tilted against you. Of course, that doesn't mean that they won't ever work or they'll never work. So I think you just kind of want to pick your spots and don't make it a continual habit of trying to find these names. And you probably also don't want to stick around too long in them as well. If that short just isn't going in, if it's still hanging on the stock kind of thing. So so overall they can work to take it, in baby steps kind of thing. But expect it's going to be higher risk. There's a reason that short interest is there, and expect some more volatility in them.
Yeah, no, I like that. Yeah, and it kind of plays off of like what we talked about last podcast too, is that forcing like an investment thesis just by owning something just because it has a high short interest ratio, like an investor's likely not going to hold that stock during a drawdown, or they won't want to hold it long term. They're essentially just waiting for that that one moment that sends it higher, and if it never happens, they just they end up owning something that they probably don't want.
And that's a good point. Is if whatever the reason for the short interest is, if that thesis is proven right, and then the stocks get hit very hard and very quickly as well, right?
Yeah.
So
Yeah.
if you want to own those names and you're wrong on it, it can hurt. So just approach with caution.
Yeah.
Yeah. So the next question that we have here is, analysts love to place ratings of buy, hold, and sell on companies. Do you use this information? So I know there's a lot of studies. Actually, I had to dig a bit to find to find a study on this, because I haven't seen anything published more recently. But in 2017, I found a study that showed only 6% of analysts have a sell or an underweight rating on a company. So obviously that should be a bit of a tell that, the buy, hold, and sell recommendations are certainly biased more towards one type of approach. And it makes sense, because it's hard to put a sell on something, because then the analysts don't always get access to management. They don't get their questions answered. It creates a bad, it can create an uncomfortable relationship with the management team for right or wrong, and you lose access, right? So typically recommendations always bias more to the buy and maybe the hold sell of things. So that alone should kind of lower any confidence or signal that you think you're going to get from a buy, hold, or a sell rating. So, but it's a data point in the toolkit. Probably wouldn't be our at the top of the list of things we'd focus on, but it can be helpful alongside other pieces of information. I think target, like if you're talking kind of the analyst side of things, target prices have a bit more signal, or a bit more helpful than the buy, hold, sell rating. Especially maybe there's a buy rating, but the stock price is above the target price or something.
Yeah, exactly.
Like that, right? So then you can kind of start to weave in a bit more of an understanding maybe of what's going on. But so target prices, I'd say, a bit more helpful than buy, hold, and sell. But I'm sure, as a lot of people know, there's a lot of data out there. I don't have any I can cite, unfortunately, but target prices aren't that helpful. They're not that accurate. And I find they can do more damage than they can help, because essentially what happens is you own a stock, it's at $10, target price is $20, stock hits $20. So what do? You go sell it, right? Because that's target price, I guess, got to sell now, which is just usually not the right decision, because you can also update a target price, and that target price might go to 40, or they just might be delayed in updating it, or whatever it is, right? So target prices can be helpful to maybe scope the size of the opportunity that analysts are seeing. Is it a 10%? Is there a 10% upside, or is there 40% upside? So that can be more helpful. But again, don't follow it like gospel. I don't think. But then where the analyst targets and all that kind of thing, forecasting is really helpful. It's just on their fundamental forecasting, right? Like their estimates for what revenue is going to be on the quarter or on the year, and what their earnings are going to be on the quarter and the year. Typically, it's actually quite accurate, and they get this right. And obviously, and the markets follow it, right? Because if a company misses the earnings estimates, in a lot of cases, they'll get hit, or they'll get rewarded if they beat it, kind of thing. So certainly, that's, I think, is really, if you're going to choose something to focus on with analysts, it's really kind of what their estimates are at the fundamental level. That's going to be the most helpful and have the most signal. And it's the most accurate as well.
Yeah, no, I definitely agree with everything said there. And it kind of reminded me of this one deep dive and kind of piece of analysis that I did years ago. And it showed that that ratings weren't overly useful, like you were saying. Price targets provided a bit more signal, where I think the study that I did showed that for the Canadian banks, the larger the gap between the average analyst price target and the actual price was, the more likely it was the stock was going to increase. And typically the larger the increase over the following year or two. So it usually happens in huge bear markets, where analysts just aren't really willing to drop their price target that much. They kind of keep it at this level where they're this is fundamentally cheap. And then the gap between the actual price and the analyst price starts to grow. And that kind of signals maybe it's pretty heavily undervalued. But I found it works pretty well with Canadian banks and some of the large tech names. So cool. It's pretty interesting. Sweet. No, I like that. Awesome. Okay, so next I'm going to go into my Q&A here. So the first question I want to review is from Tim, and he says, "I would like to get your opinions on what investors should do given possibility of an inevitable market correction. Many portfolios have gone up over 25% this year, which is likely is not sustainable. Should we move to bonds? If so, where?" So our response is here, and I won't read the whole thing, but essentially, we kind of mentioned that like market corrections can happen from time to time. One thing that's interesting is the S&P 500 has seen 320+% declines in the last 5 years, which is quite rare across history. So I was thinking that, the next correction could be time-based versus price-based. We could see something similar to 2015 where it just kind of goes sideways, but it's not a huge drawdown. And it really that would just test investors' patience. But for an investor that is preparing for that potential correction, we think bonds is one area that can hold up well. But really, we would prefer positioning a portfolio more conservatively via like sector rotation. So essentially looking at, defensive sectors like utilities, consumer staples, and U.S. healthcare. They tend to perform pretty well in market corrections, whereas those cyclical sectors like tech, communications, discretionary, industrials, financials, they tend to outperform on the upside, so in bull markets. So it's essentially, if we think an investor is like preparing for a correction, we think the best approach is really like going down the risk curve. And so on that, I wanted to demonstrate some charts that I have here. So this is essentially like an example of the risk curve and looking at different sectors. So specifically, this is U.S. sectors. So essentially, as you go to the right on this graph, you're looking at higher risk. And as you're going up, you're looking at higher returns. And it shows that, I'm just going to go to the next slide where you see, like, that's the curve essentially. That's the risk curve. So, as you go up and to the right, an investor is taking on more risk, but potentially seeing more returns. And then as an investor shifts down into the left, they're, reducing their risk profile, but also willing to take on less returns potentially. So that's kind of the risk curve. And then, just because I thought this would be really interesting and investors likely want to see this, these are individual Canadian stocks along the risk curve. So that's kind of like an example of the risk curve. So, bottom left, we have Hydro One, H is the symbol. That's kind of like the epitome of like the low risk, low return profile.
Before you go into the next company here, did you just copy and paste this line here, because this is not fit like I would think? Okay, all right.
No, it's so yeah. In investing, there is like an actual way to calculate the they call it like the efficient frontier line, and that's what that line is supposed to represent.
You just went for it though, and
this is more of like an example.
All right, I like it. Okay.
Yeah, so it doesn't fit the names, but it's kind of like illustrative of the efficient frontier. But yeah, essentially, as you go up into the right along the risk curve, we're seeing names like TBK, TerraVest, Vital Hub, VHI, First Service, FSV, Kinaxis is down there. And like ideally, investors want to look at names that can be the highest up along the curve. So, if you can point at any stock and you can go exactly to the left and you're still getting like the same return profile, that means that the risk is being reduced, but returns are kind of, the exact same return profile. So like CSU is along the same line as pretty much TerraVest and SOBO. So that's kind of an example of how to look at the risk curve, which I tend to do for myself. So yeah.
We'll get you Microsoft Paint so you can draw these lines a bit more.
Like that,
actually,
yeah. Use some AI.
Squiggly line, yeah.
All right. Nice. Okay, and then question 2. So this one's on Constellation Software, CSU. So really topical kind of thing right now is CSU, and And a member asks, Nizar asks, is it, it's going down every day and insiders are selling. Should we sell? Maybe AI is hurting it. Um, and, this is our response here. So essentially, we mentioned it's a shorter response, but we kind of say insiders own 6.2%, worth about 6 billion. Stock has been weak, but we don't think it's a sell, based on tight control on stock issuance, long-term track record, and growth prospects. So I wanted to talk about CSU just because it's been getting so much attention recently because it's been a great performer over the last decade or more, and yet it's kind of been choppy and flat. So this is its share price performance over the past year. We can see it's very choppy, pretty much flat. But then I wanted to zoom out, and this is essentially its share price performance over the last 20 years.
Like that split barely a blip, right?
Yeah, exactly. So yeah, 35% CAGR over 20 years. And when we look at the share price performance that most investors are talking about, it's that orange highlighted circle there. So zooming out really helps with Constellation.
And in fairness, Constellation too, they're not even down year to date. They're flat.
They're still up, yeah.
Yeah, it's peak to trough. Yes, they're down or whatever.
Yeah.
But I mean, it's been a fantastic name, and investors have been very fortunate that it's pretty much only gone slowly but surely up to the right. Right. So it's and this year, sure, they're underperforming, I guess, but it's not like a disaster either, right?
Yeah. And I just wanted to talk about one more point too. So this is their drawdowns on it's a monthly basis, so it's smoothed out. But we can see it's, on the month, it's peak to trough. It's down 14% from its high. And we can see that that's not the only instance we've seen that sort of decline. So saw it in 2008, 2015, 16, was the 2019, 2022, and then now. So I honestly think that Constellation Software is at a pretty attractive level for investors that have been priced out of the name, have always wanted a position, but it just kept going up against them. So I think this is kind of what I would call a relatively easy buy. This might be, the equivalent of a Tom Lee granny shot right now. So I think software has been indiscriminately sold off. And then if you look at the leader in software in Canada, it's Constellation. And the drawdowns pretty much just in line with major historical drawdowns for the name, and yet it still has a 35% compounded return over 20 years.
And we talked, and notice in the question they mentioned the software versus AI debate or whatever, and we talked about that. I won't rehash what we said last time, but last time we talked, we discussed that whole trend or theme and how we think it's a bit misguided. I think, though, I don't know if this is what the kids are saying now, we should give ourselves some flowers here or whatever, that because 5i, our first report at 5i on Constellation Software was, I think it was triple digits. It was $100 or something like that. And I remember when we first kind of released that report, it was, it's too expensive. It's trading at, I can't remember what it was, but 40 times earnings or something like that. I don't know, if we should buy this or whatever. And but that was the first year. And then I guess 5i has been around for 12 years now. So I'm pretty sure it was one of the first reports we did also. And for the last 12 years, every year it's been, looks a bit too expensive. Don't know if I can buy it. Every year it just kind of chugs along. Right. Doesn't say it's going to always continue that way or whatever. Right. But, and then lo and behold, we get the shares are a bit cheaper now, and it's
that's right.
Talk about if it's how it's looking better valuation wise or anything like that. So I think we should deserve a bit of a pat on the back on that one, maybe. So
it's been a solid name, and I know they have that AI kind of meeting that they're doing just to reassure investors. And so I really think it's one of those moments for investors that might take a little bit of time for the turnaround. It could take a few months, could draw down a bit more, but over a long period of time, if investors want a high quality name in their portfolio, Constellation's a good place to look. So the next section I want to talk about is highlighting a recent 5i report. So this one's on Element Fleet. The ticker is EFN. So this is a leading global provider of fleet management solutions, including, leasing, rental, integrated fleet services, and they serve both commercial and government sectors. It operates a diversified fleet across different regions with high margin services like maintenance, telematics, fuel management, which have really recently become key growth drivers. And recent results have shown strong recurring revenue from its services segment. It's showing good operational efficiency, margin expansion. And so kind of the business model is EFN basically borrows money at low rates. It purchases vehicles for clients under a lease structure. So they'll lease it from EFN, and then it earns the spread between the two. This helps to generate predictable cash flows. And then at the end of the vehicle's life, it auctions it off, pays off the debt, and then just repeats this cycle. And then the second driver of sales is through services. So that's maintenance program fees, fuel management, telematics, which is like GPS, wireless data within the vehicle. So stats wise, it pays a small yield of 1.4%. It's up 28% year to date. Analyst earnings estimates are rising, and it trades at a pretty reasonable valuation of 20 times forward earnings. So nice little name there.
Yeah, growing double digits too, right? It's a 15 to 20% top line grower. I mean, 2024, I think it was closer to 7%, but it's, oh, sorry, that's net interest income. No, it's still right on revenues though, like 10 to 15% kind of thing. So decent growth for lower valuation. Now, I mean, these names will be cyclical too, right? If you hit an economic slowdown or whatever, these names do tend to get hit. But again, it kind of goes back to sort of that long-term thinking, like we were just talking about with Constellation softwares. When you zoom out, that they kind of just look like little, or the dips are hardly even noticeable, kind of thing, right?
With the high quality names, yeah. No, it's very true. All right, so moving on to the final segment, I want to talk about a piece of investor education. So, within investing and portfolio management, I see a lot of information and resources on like position sizing, diversification, whether it's like diversification across geography, sector, asset class. There's information on, growth versus value stocks. But one thing I haven't really seen talked about much before is conviction. So to me, having conviction in a stock is, really like a superpower. So the best example I can think of, the real world example, is the Canadian banks. And I think this helps to explain why so many Canadians own and have done really well with the Canadian banks. It's because, every time that there's like a market meltdown or a major crisis, the banks will get hit. But I see a theme where like investors, they're willing to buy more of the Canadian banks. They definitely hold on to them. And then they look at them and they're like interested because, they have conviction in them. So Canadians, they know the products of the six banks. There's only so many banks in Canada. And everyone just kind of has this like underlying understanding that these giant banks in Canada aren't really going anywhere. So every time there's like a mild recession or a market drawdown, the banks, everyone likes to hide out in. And that's because they have that conviction.
They like those dividends too.
Yeah, they like the dividends, big dividends. So it's always good. And so, really, I think if there's a topic that investors should consider when they look at their portfolios or they're doing portfolio management, is buying and holding high quality names that they have conviction in. Because this helps to not only hold during major bear markets, but also investors can maybe buy more on the dips with conviction. And so maybe it's not even a Canadian bank or like a large defensive type name. It could be a high quality, high growth, high valuation name. But the next time US tariffs or whatever comes out and drops the market 30+%, if an investor is at least familiar with, like really comfortable with the name, they like the management team, they've, listened to podcasts with the management, or like seen them tweeting consistently, just having that like brand awareness, like everything, knowing everything about the company and its products really helps, I think, with portfolio returns over the long term.
If the management team tweets consistently, that might also be a sell signal too. Though, if they're a little too aggressive.
Tweeting too much,
No, I would also like, Conviction, yeah, almost just call it like knowing what you own too, though, right? I think sometimes if you're too high conviction, but it can get you into trouble spots as well, where you are not seeing the changing landscape or a change to your fundamental thesis, or your and if you're doing kind of sometimes if your conviction's too high on a name, not too high, but I just think it can get you into trouble where you're not seeing a change in your thesis, or you're ignoring it. Maybe you even see it, but you ignore it because you're so convicted on thesis XYZ that you're so aware of, and you don't update your priors with this new thing. So you're certainly right though, in a nasty bear market that's broad based and all that kind of thing. Conviction's helpful because then you already know the names, you know how they work, what the outlook for them is, and so it's easier to buy them at that time. But I think outside of call it a market wide type of drawdown, if your just company is in a 50% drawdown, that conviction, you might be right, but that conviction can get you into a tough spot as well, where you're continually to add to something where maybe you're just wrong on it as well. So it's you can just
could be a double-edged sword. Especially if it's a brand that like maybe the investor buys religiously and they love that product, but like maybe they're not realizing that like other people don't really like the product anymore or something, right? Then they have conviction, but
and you can have rules that get you around that as well. So maybe your high conviction name, but like I don't like adding to like doubling down on names or adding to names that are losing kind of thing, just because maybe you are wrong on that name, right? So you can have high conviction on it. Maybe that conviction is just, I'm not going to sell it, I'm going to hold it until that positive momentum returns and I get a bit of confirmation that this was, and then you're probably gonna have time to add to it at a lower price anyways. So it's just, but because I know also just continually to buy declining names can get people into a lot of trouble. But no, that's I totally get where you're coming from on the conviction side here. You gotta know what you own, right? And why you own it too.
Yeah, and there's a lot to be said about like position sizing within all of that too. But that will be a topic for another day. So with all that said, that's all for today. We hope you enjoyed this episode of our podcast and learned something new about the Canadian and US markets. If you want access to more exclusive content and insights, don't forget to visit our website at 5iresearch.ca and sign up for a free trial if you haven't already. You can find the link in the show notes below. And if you like this episode, please give us a thumbs up and subscribe to our channel for more updates. Thank you for listening.
3, 2, 1.